Hi, this is Drew Tignanelli. It is 2011, the first quarter, and I'm going to do the quarterly commentary a little different. We're going to give you the same format that we do on our client alerts. You can read just a few bullets. You can read the commentary that we've written out for you, or you can watch the video, which we're preparing right now, or you can do all three. So we wanted to see how this works and see how our clients like it. So anyway, what are we thinking about for 2011? Here's my take on 2011. We're very cautious, yet the market says, no, don't worry about anything. It's bullish. Everybody's bullish. The market's going up. It went up 100 points yesterday, being Monday, January 3rd, the first day of the year. Looks like it's going to go up today again, Tuesday, January 4th, but we'll see at the end of the day. The point is that everybody is bullish. Everybody seems to think that the Federal Reserve has this under control, that the government has gotten us out of the crisis and we're moving on. I don't disagree that there are some economic signs of revitalization seem to be taking place, but I am concerned that we really haven't fixed any of the problems. In the commentary, I don't talk about this, but one of the things that I have been concerned about is the stark similarities between the Great Depression and today. Now, don't get me wrong. I'm not saying we're going back into another Great Depression. I'm just saying that history tends to rhyme, not repeat. You know, when I say it tends to rhyme, not repeat, I'm referring to that you can't go to the Great Depression and say, oh, this happened, so this is going to happen here, and that happened, so this is going to happen here. What I'm saying is that when you look at the similarities of what happened then, it can give you clues to what you should be worried about in this decade. And again, you can't think that it's going to happen exactly. But the thing that I noticed about the Great Depression is how much similarity there has been, especially in the markets, between today and now. For example, you had a debt implosion, you had a bank implosion, you had a Wall Street implosion, you had government now starting to spend money like they had never done before, with all kinds of government programs and so forth. Government taking on debt like they had never done before. You had a war going on, World War II. Now, we have a very different type of war, but it's still a war nonetheless. It's costing us billions of dollars a year. You had an invasion on U.S. soil in the early 1940s, and you had an invasion on this U.S. soil in 2001. You had corporate corruption. You had corporate corruption in the United States in the early part of the year with Enron and WorldCom. You had a housing collapse. You had a housing collapse in the Great Depression. You had a housing collapse now. There are tremendous similarities. One of the things that hasn't happened in this decade that has happened in that decade was a crash. And a crash is defined as a market that goes down by more than 20% in one day. The interesting thing is that I believe that will ultimately happen at the end of this secular bear market, as opposed to it was the beginning of that secular bear market. I think that what has happened is the government and the Federal Reserve have tried to save us from the debt implosion. The only thing that can save you from a debt implosion, based on my historical understanding of finances, is to let the implosion continue until it's washed out, and then you resurrect the financial system. They're trying to not let that happen, and because of that, I think we're going to continue to have these up and down periods. We're going to have these periods now where it looks like everything's getting better, and then you're going to have new periods when things look like they're never going to get better again. And right now we're in one of those positive times. That's why I warn that we need to be vigilant and cautious about how we're investing our money, and you also need to be extremely vigilant and cautious about the way that your 401k that we don't manage is being handled. And so we recommend that you be extremely cautious in those monies. Some of the things that we're also concerned about, we're concerned about sovereign debt, like in Europe. We're concerned about state debt here in the United States. We believe Illinois has a good chance of going under, and we believe that California could ultimately have default problems. There's quite a few other states, such as Ohio and Nevada, and Rhode Island has some serious problems. Connecticut has some problems. But Illinois is the big one. So there are a lot of issues that we're concerned about. Our housing market is not going to be revitalized until we figure out how to fix the mortgage companies, Freddie Mac and Fannie Mae. I like how they continue to tell us how much money they're making on the bailout of the U.S. financial system, but yet they have not explained how much money they've lost in Fannie Mae and Freddie Mac. Last I heard, the number's at least $150 billion, and they're expecting when it's finished to be over $500 billion. So we need to be cautious. Commodity prices are rising rapidly. History has tended to say that when commodity prices rise like this, it's not a good time for the stock market. They tend to be counter-cyclical with each other. Anyway, the point of the matter is, we're cautious. You should be cautious with money that we're not managing. Any money that we have, we're being cautious, and we're invested in the places that we believe are going to make us reasonable rate of return without taking a large amount of risk. Commodities, Asia, Asian currencies, blue chip stocks paying good dividends, and technology when we get a chance to buy it at the right price. Anyway, if you have any questions, always feel free to call us. Also read the commentary, because there's some good financial planning points about things that have happened, the new estate tax law, the new income tax law. You really need to keep up on some of these things, and when we get together in our client meetings this year, we're going to be talking about the new estate tax law and what it means to you, your estate planning. All right, for now, this is Drew Tignanelli saying God bless.